Yeah, hi there. This is Bernhard Koepp from CJ Lawrence coming to you from snowy Midtown Manhattan. So it's been quite a week, and I'm not talking about the Oscars on Sunday that were quite uneventful, but the bank run that we saw relating to Silicon Valley Bank was certainly Hollywood worthy. It was not like in A Wonderful Life where Gary Cooper was the hero of the day. This all kind of played out more in the social media sphere, which was really on Twitter. And once the word got out, or the rumors got out, that Silicon Valley Bank was somehow having problems with its balance sheet or having a mismatch of its assets and liabilities, and had contracted Goldman Sachs to raise capital, rumors started spreading about the viability of this bank. So even if it was true or not, whether this bank actually had real problems, it really didn't matter anymore, because once the rumors started taking hold in social media, it led to its customers withdrawing something like $42 billion in one day. And certainly no bank of this size, and if you look at Silicon Valley Bank at the peak, it had about 180 billion or 190 billion of customer deposits in it. If it loses 42 billion in a day, that's something any sort of mid-sized bank cannot really survive. So what's the repercussion of this? So what happened was the banking regulator took it over. And over the weekend, there were all sorts of rumors again about the bank being taken over. Certainly, if you were a shareholder in this bank, you were wiped out to zero. And the government was quite adamant, and the Federal Reserve and the banking regulator was quite adamant to reassure the public that deposits in this bank, including other banks who were now suspect, would be safe. So one of the things that happened was the Federal Reserve opened its overnight lending window to also the smaller banks. This is something we've seen before in the great financial crisis of 2008. So there was lots of government officials and Fed officials going out there and basically saying, listen, depositors are safe, which doesn't mean shareholders are safe, but depositors are safe. So here we are on Tuesday, and we're trying to figure out, what does this mean for what's going on? So first of all, in the financial sector, the banking sector, we are now seeing the large banks like JP Morgan opening accounts for customers that are fleeing from the smaller banks that are considered more unsafe. And we're seeing this big sucking sound of assets and deposits moving from the weaker banks to the bigger banks. Well, that's something that typically happens during adverse business conditions. You know, that's why we follow an investment philosophy which we call bulldog investing, where we like to invest in companies that take market share during adverse business conditions. And what is certainly happening here is that companies or banks like JP Morgan are taking market share from smaller competitors, and we think that will continue. So if you're patient enough to invest in banks in these sort of uncertain days when it comes to inflation and interest rates, certainly the bigger banks are getting stronger in this downturn, and on the way out, I wouldn't be surprised if they benefit from that. So that's on the sector level and the company level. On the macro level, it's quite interesting. Within 1 week, the whole outlook for what the Fed will do when it comes to interest rates has changed. So up until a week ago, before SVB went away, it was still expected that the Fed would be quite aggressive when it comes to raising interest rates. That has now changed quite dramatically. If we look at something that's called Fed Funds Futures, which is a futures market that shows what the market thinks the Fed will do in terms of raising interest rates, Fed funds are now quite flat for the next couple of months. So the expectation from the market's point of view is that the Fed may only do another 25 basis points and then maybe be done. It's interesting, if you look at the Fed funds future rates, it's even pricing in rate cuts starting in June. And it's actually 3 rate cuts that it's pricing in for a terminal rate of Fed funds at about 3.75, which is a huge change from a couple weeks ago when the terminal rate of Fed funds was still at around almost 6%. So if we think about valuations and how that affects valuations and PE ratios, that's a huge change. So one of the things that our companies as well and our stocks had been suffering from in the last year is this notion of multiple compression. So if inflation is high and the Fed is raising interest rates dramatically, you typically have multiples, that is the price to earnings ratio, compress. And in our investment style, where we like to invest in companies that deserve a premium valuation over the market, so these are companies that grow faster or more consistently or have technologies that are unique and they have a competitive moat versus other companies, these companies tend to get premium valuation. So in a multiple compression environment, these companies tend to get hit more. So for us, as a slightly more growth-oriented type of investor, these are tougher times when multiples compress. So the good news for our investment style now is that now that the Fed may be closer to done, I mean, that was our expectation already a couple of weeks ago, but with this banking crisis that we saw where if you think this through, I mean, small banks are now less likely to extend lending loans to smaller businesses. Why? Because they need to look after their balance sheet, their deposit base, which is the cheapest part of their capital, and they also will be subject to more onerous regulation, banking regulation. So if you think about the banking regulator, they're using money that was paid into the FDIC's fund to cover depositors. So as you saw, our president went out yesterday and said no taxpayer is on the hook for any of these deposits. That is true for now, but because they are tapping into the fund that was created by the banking regulator and quite aggressively after the 2008 crisis, where obviously you had bank failures. So those funds are being tapped, but you can be rest assured that after this, the regulation regarding that fund are going to be much more onerous, especially on the big banks, to make sure that that is properly funded. So the good news, obviously, then is if we're looking out into the future in terms of interest rates, we may see some relief there from the Fed because the Fed does not want to break anything else. And we have said in the past that one of the things that was missing in this cycle was we haven't seen a credit event. So we've now seen the credit event, which is these banking failures that we've seen and the contagion that we've seen into other banks. There are rating agencies today like Moody's that have put 5 other banks on credit watch, and one of the other banks, California-based banks that we've seen that's also been in the news is First Republic. It's a solid bank for sure, but there is an association with what happened with SVB, so we'll see how that plays out. But certainly things, if you're a smaller bank and you've seen these withdrawals that are probably going to bigger banks that are safer, there has been quite a shift in terms of how risk is perceived amongst these different banks. So on the macro side, just to finish that off, we saw CPI this morning, February. I mean, everyone was a bit nervous about CPI because the last thing we want here is a credit event like this happening, which is obviously negative for economic activity. But what we don't want is inflation to continue to roar ahead. So, and that would be stagflation. So, and that was kind of what the market was pricing in last year, and the reason why both equities and bonds didn't work. So luckily, we got CPI, and that was pretty much in line with expectations. The headline reading of CPI for February was 6%, and that is now that was in line with expectations, and is at the level, we are at the level now of September 2021. So that's progress. Also on the core side, which is the more, the better reading of inflation in a sense, because it takes out food and energy and things like that. So that was at 5.5%. So our expectation is still that, inflation continues to come down, and our base case on a more constructive market for both equities and bonds for this year is with inflation continuing to come down by the year end. So if we look at some of the economists now, it's quite interesting. There's a lot of disagreement among strategists and economists. We see economists at Goldman Sachs, for instance, who now said they no longer see a 20 basis points, 0.25% interest rate hike in March. So that's quite a change from just a couple weeks ago. Bank of America, they are still a little bit more, have more of a hawkish outlook when it comes to interest rates. So they see 25 bips going every meeting through May for a peak rate of about 5.25 or 5.5%. And then you have also much more dovish economists at banks like Nomura, who are even saying that we may even see a cut of 25 basis points on the 22nd of March, and balance sheet reductions when it comes to what the Fed is doing. I mean, I think that's wishful thinking, but you see what I mean? The community that follows these things very closely is now seeing an end to this interest rate hiking cycle that has been so detrimental to asset valuations in the last year. So the outlook obviously is a game changer, and that bolsters our view that, and typically when interest rates peak or actually interest rates come down, that's typically very good for both stocks and bonds. So we're quite happy about that. Thank you for listening, and shoot me an email at bkoepp@cjlawrence.com if you have any questions, and I'll see you at the next video. Bye-bye.